so for everyone, risk factor is the stock market in general. Just by being stocks, they have risk. And then they can have idiosyncratic risk factors, but we'll talk about that later. Okay, so this is what a lot of smart people came up with. Some Markowitz and a couple other finance people came up with the CAPM. So basically, let me break that down. Return on assets, R, that's basically our stock. The return that it needs to generate just by being a stock is the risk-free rate, in our case the 10-year treasury, and the beta, and the market risk premium. So the beta, anyone know how to calculate beta? Someone who's not Richard. Come on, you guys all take finance classes. Okay, Helen.
So you regress the price change of a stock over the price change of S&P 500?
Yeah, and it's really important to say that it's the changes. It's not the price specifically against the S&P 500. It's the fluctuation in price versus the fluctuation of the S&P 500. Because if a stock drops from $100 to $50, that's a 50% drop, whereas it drops from $8 to $4. So there's a magnitude issue. I'll talk about that briefly in a second. And then this finally is the market risk premium. And if you were at the last WUSIF meeting, there was a big debate about what this actually is. So basically, what it needs to pay above stocks just because it is a stock. And you can think of beta as a measure of how much really is it a stock? How much is it the same exposure as the stock market? And that is the risk-free rate, and that needs to worry about. Okay. So this is beta, measures the fluctuations. This is ACAS, the one that Trevor pitched on Wednesday. If you want to look for beta, a good website that I use is Wolfram Alpha. It's what a lot of math majors use and stuff. You can just type in ACAS beta, and it gives you a chart that it automatically generates based on current data, which I like. If you want to use the Yahoo one, I would say the Yahoo one's pretty outdated. Anyway, so if you notice the R squared on the beta is 31%. If any of you know like regressions, and this is for the people who are more finance majors, what do you think the average R squared is on betas? How much of the fluctuation in price is explained by the finance fluctuation? What do you think?
Like 30 to 40%?
It's actually a lot less than that. The fact that this is 30, I think, is really pretty crazy because on average, I think it's 19%. This was a question that was an interview question for investment banks. It was on our AFM database of questions, and that was one of the questions. And I would say on average, it's about.
Wait, what's alpha?
Okay, alpha. Wait, alpha is the intercept when you regress it.
Oh.
So basically, alpha is how much the stock generates just above the market as a whole. So if you think about it like, I don't know how to talk. Let's see. If you think about it, so like a regression, you predict you have a bunch of points, and you try to draw the best line from them. And so if it has a positive alpha, then the stock generates money over and above the stock market always, which is good. And so you're seeking alpha. And that's the name of that blog, Seeking Alpha. It's because alpha is what you want. Unfortunately, alpha isn't always statistically significant. And I wouldn't say that stock actually generates.
So alpha is basically the rate of return on stock? So alpha is the rate of returns on stocks?
Well, if you think about it, this axis measures the fluctuations of. Oh, hello. Are you guys here for QBA?
Yeah.
Does it start at 3:30?
Yeah.
Will you guys be willing to wait till then?
Yeah.
Great, thanks. This is the fluctuation in the price of the stock, or the stock market in general. This is the fluctuation of our stock. So that means that on average, when the stock market fluctuates 1%, our stock will go up, in this case 2%, and it has an alpha of 10. Yeah, so basically the slope is 2, and the y-intercept is 10. So if we were to write a model for the price of our stock, it would be like 2 times the S&P 500 plus 1%. The thing is, I wouldn't say the alpha is really statistically significant. When you run that in Excel, you should check it out. It could be just a random number in this case. And I think it is, because 10% seems a little wild. All right. Questions on beta?
What was that website you said you went to calculate it?
Yeah, so the website I said is Wolfram Alpha. It's pretty cool.
Cloud-based Mathematica, basically.
Yeah. So basically, It just is a compiler of different formulas. And anything that you can do with a computer easily, it should be able to do. And you say like ACAS beta, and then it calculates it on the spot. And it uses real data, and it gives you a graph, and it gives you the values.
Cool.
And so like I pitched CBI, and I think their data was about too. Unfortunately, as you can see, they're using last 5 years data, which I would say would be questionable for a beta coefficient.
Are you serious?
And ACAS, no, this is Chicago Virgin Iron.
You can change it.
Yeah, yeah, last 10 years. I think the alpha would, I don't know, the alpha went up actually. Yeah, wow.
What are those big?
So yeah, so this is 24%, 24% R squared.
Is that good or bad?
Well, the R squared, I don't know. I look at the R squared sometimes just because if the R squared is overly high, that means that the beta is like directly, well, that means that it actually has market exposure, and we're confident that it does. So that means that 30%, or in this case 24% of the fluctuations in the stock are explained by the stock market. So I think like like construction companies, I think will have a higher R squared on this kind of stuff. But that's of course questionable. I'd have to do some extra research about that. Okay, and I'm almost done with my presentation, so I haven't even done it in 30. Okay, market risk premium. Basically, we talked about that is the what the stock needs to generate just over, or what the market in general needs to generate over and above the risk-free rate. So here's my logic. So from 1926 to 2008, there's a 10.3% return. So you guessed 10 to 12. Yeah, that's about 10.3% return. So in the last 5 years, it's returned 3.35% a year. So it's not always the same way. But the return on market minus the risk-free rate is, of course, what we're looking for is the market risk premium. So I'm going for 10-ish minus 4-ish, which is the treasury rate, is about 6-ish. And if you take a class AFM with Milborn, he'll say it's 6%. And he'll say internationally it's been 5.5%. So in this case, I would say use 5.5, just because I'm not as confident and I don't think other analysts are. But what's important to note that it's not like what reality we're seeking. We're not seeking a forward prediction of reality in this case. We're seeking what the other analysts are using. Because what the other analysts are using will reflect every other stock price. And that really is what we need to look at when we're talking about discount rates. Because we need to look at other investments that we can put money into. Other stocks with the same risk. And so internationally 5.5%. I'd say use that. But of course, people will have different ideas of what the cost of capital is for different companies. And some people have an idea that it's 3% or 1%. So really, I want to see a sensitivity analysis on all WUSIF presentations from now on. So that's saying, as the cost of capital increases, it needs to generate higher and higher returns. So the net present value will keep dropping, and the price per share will keep dropping. I think this is for CDI, but this is based on old data. Okay. So I want to see something like this in everyone's presentation. If you don't know how to do that, I'll talk about it later. Question?
How to do the sensitivity analysis?
Okay, I'll demonstrate that briefly. I'm going to actually do an example. I wanted to do an example of how to do this. I was going to have you guys just choose a random company and we could do it. Okay. So, and finally, as I mentioned, you can add more variables into it. So it might have exposure in the market. So when the market moves, it moves. But it might have exposure in other stuff, right? So for example, it could have political risk. Just because it's in Venezuela could mean that the prices will fluctuate more. And it could have market risk just being a really big company or a really small company. And so you can add other variables. And Fama and French tried to do it. Fama and French, sorry. And they have the 3-factor model. It's basically CAPM, but with 3 factors. This is the market return that we talked about over the risk-free rate. This is small versus big, right? Who's taken Praxis? I guess you guys haven't. Small versus big, and that's high versus low. That's alpha, and they also added momentum 1. So basically, other factors could be influencing it. Unfortunately, this model isn't statistically significant according to Fama and French, and you can do the regressions yourself, and you'll see that it's not very statistically significant. So basically, for WUSIF, we're using